Tax Planning Fundamental. Disclaimer: this document does not constitute tax advice. For specific tax-related questions, consult a tax professional. What is tax? In simple terms, tax is a portion of your earnings taken by the government. However, the reality is more complex. Taxes can be broadly categorized into three types. 1. Direct income tax, tax on employment income, rental income, etc., commonly known as income tax. 2. Capital gains tax. Capital gains tax is tax on profit from buying and selling assets such as homes, shares, or artworks. This tax is prevalent in Europe and the U.S., with rates typically ranging from 20% to 30%. 3. Wealth inheritance tax, a tax imposed on the transfer of wealth to the next generation, common in Europe and the U.S. On June 8, 2021, ProPublica released a groundbreaking report revealing that the wealthiest 25 individuals in the United States paid minimal taxes relative to their wealth growth. For instance, Warren Buffett of Berkshire Hathaway Incorporated paid only $23.7 million in taxes from 2014 to 2018, despite his personal wealth increasing by $24.3 billion during that period, resulting in an effective tax rate of 0.1%. Jeff Bezos, founder of Amazon.com Inc., paid an effective tax rate of 0.98%. Michael Bloomberg of Bloomberg LP paid 1.3%. Elon Musk of Tesla Incorporated paid 3.27%. This raises a question: why should we understand tax and tax planning, and what can we learn from the tax strategies of the ultra-wealthy? While tax planning may seem irrelevant to the average person, gaining insight into the strategies employed by the world's richest individuals can offer valuable lessons. This video aims to provide a fundamental understanding of these strategies commonly adopted by the ultra-wealthy through the three types of tax. 1. Direct income tax. The formula for direct income tax is: income tax equals income deductible expenses multiplied by tax rate. To minimize direct income tax, we should therefore be focusing on 1. Reducing taxable income, 2. Maximizing deductible expenses, and 3. Optimizing the tax rate. Element 1. Income. Reducing taxable income is the most straightforward method to lower tax liability. CEOs and top executives often receive minimal salaries for two reasons. Reason 1. High salaries can attract negative publicity. Reason 2. Lowering income reduces direct income tax. Many CEOs, such as Mark Zuckerberg, Facebook, Larry Page, Google, and Larry Ellison, Oracle, hold significant shares in their companies but receive minimal salaries. For example, Larry Ellison of Oracle, Ellison, the co-founder of Oracle, famously took a $1 annual salary for many years. Instead of receiving a high salary which could be taxed at up to 37% in the U.S., he earned income through stock options and dividends, which are taxed at lower rates. This strategy allowed him to significantly reduce his taxable income while still benefiting from Oracle's growth. Element 2. Deductible expenses. While ordinary individuals use after-tax income to cover living expenses, the wealthy use pre-tax income for expenses. This allows them to deduct these expenses from their taxable income. For example, expenses related to travel, dining, conventions, and even clothing can be classified as business-related and thus deductible. A notable example is Jeff Bezos, the founder of Amazon.com Incorporation, who in 2007 reported $46 million in income but paid no federal income tax. He offset his income with losses from side investments and deductions such as interest expenses and other expenses. Another famous case is Richard Branson of Virgin Group. Branson often uses his private island, Necker Island, for business meetings and events. By classifying these trips as business-related expenses, he can deduct the costs from his taxable income. This includes expenses for flights, accommodations, and even entertainment for clients, all of which are justified as necessary for business operations. Donations as deductible expenses. Charitable donations are a common tax-saving strategy. For instance, GoPro founder Nick Woodman donated $500 million to a charitable trust after GoPro went public. This donation, made to the Silicon Valley Community Foundation, allowed Woodman to control how the funds were spent while benefiting from tax deductions. A famous case is Bill Gates of Microsoft, who donated billions to the Bill and Melinda Gates Foundation, a charitable organization. By donating Microsoft shares instead of cash, he avoided paying capital gains tax on the appreciated value of the shares. Additionally, the donation reduces his taxable income, providing a double tax benefit. Another common strategy is art collections. Wealthy individuals can donate high-value art collections to charitable organizations, claiming tax deductions for the donated value. This not only reduces direct income tax, but also minimizes capital gains tax. Element 3. Tax rate. Shifting from a higher to a lower tax bracket is another strategy. For example, during Donald Trump's presidency, the corporate income tax rate was reduced from 35% to 21%. Wealthy individuals can also transfer personal income to corporate income to benefit from lower tax rates. Additionally, companies are often established in low-tax jurisdictions such as the Cayman Islands or Horgos to take advantage of favorable tax rates. An illustrative example of shifting profit to lower tax brackets. The strategy involves reclassifying income from higher tax categories such as salary to lower tax categories such as dividends or capital gains. For example, small business owners, instead of paying themselves a high salary which taxed at 37%, the business owners could pay themselves a lower salary and take the remaining profits as dividends which tax at 20%. For example, if the business earns $1 million per year, the owner could take $200,000 as salary and $800,000 as dividends, saving $136,000 in taxes. Offshore tax planning. Strategy. This strategy involves establishing entities in low-tax jurisdictions to centralize profits and reduce overall tax liabilities. For example, a tech startup based in the U.S. sets up a subsidiary in Ireland which has a corporate income tax of 12.5% to hold its intellectual property. The Irish subsidiary charges royalty fees to the U.S. parent company for using the IP, shifting profits to Ireland. This reduces the U.S. company's taxable income and overall tax liability. Research and development, R&D, incentives. Strategy. This strategy enables taxpayers to claim tax deductions or credits for qualifying research and development activities. For example, a pharmaceutical company invests $2 million. Under local tax jurisdiction, a total amount of $4 million research and development expenses are deductible, which further lowering taxable income. 2. Capital gains tax. For the wealthy, the strategies mentioned above are preliminary. Their primary source of income often comes from the appreciation of share prices. For example, Elon Musk's wealth increased by $100 billion in 2020, making direct income insignificant in comparison. The key principle is that tax is only levied on realized gains. As long as investments remain unrealized, no tax is due. For instance, if a painting is sold for profit and the proceeds are reinvested, the gain is not taxed. This is why the effective tax rates for the wealthy are so low. Their wealth is tied up in shares, and the appreciation in share value is not taxed until the shares are sold. To access funds without realizing gains, the wealthy often use their shares as collateral to borrow money. As long as share prices remain stable, they can continue borrowing without triggering taxable events. To illustrate the concept further, here is how to use a strategy to avoid selling assets to defer capital gains taxes. For example, a real estate investor owns a property that has been appreciated by $100 million. Instead of selling the property and paying $20 million, assuming capital gains tax is 20%, the investor uses a property as collateral to borrow $500,000 for personal expenses. By not selling the property, the investor defers the capital gains tax indefinitely. 3. Wealth inheritance tax. In the U.S., when wealth is passed to the next generation, the appreciation in value is not taxed. However, beneficiaries may be subject to inheritance tax, which can be as high as 50%. To minimize this tax, the wealthy often establish trusts, such as family charitable trusts. These trusts not only provide tax benefits, but also allow the beneficiaries to receive income from the trust without incurring inheritance tax. Here is a simple strategy illustration of establishing trusts to minimize inheritance taxes and preserve wealth for future generations. For example, a business owner sets up a family trust to hold shares of their company. When the owner passes away, the shares are transferred to the trust, avoiding inheritance tax. The trust then distributes income to the beneficiaries such as their children without triggering additional taxes, ensuring the wealth remains intact for future generations. Conclusion. Understanding the tax strategies employed by the world's wealthiest individuals can provide valuable insights into effective tax planning. By focusing on reducing taxable income, maximizing deductible expenses, and optimizing tax rates, individuals can minimize their tax liabilities. Additionally, strategic investments and the use of trusts can further enhance tax efficiency. However, it is crucial to consult with tax professionals to ensure compliance with local tax laws and regulations. Thank you for taking the time to watch this video. We trust it has provided you with a foundational understanding of tax planning. We would greatly appreciate your feedback and are always eager to hear from you.